Hey guys, how's it going? It's Seth. I'm back again. Today is Christmas Day observed, I guess is what they call it. And the market is closed, so I wanted to go over kind of developing a successful dividend stock strategy and really kind of these strategies that helped changed my life and helped change my portfolio. So let's just get right into it. And the first one is the pillow test. Now, I read this from a book, Dividends Don't Lie. And this really kind of opened my eyes and helped me not purchase stocks that I was going to purchase. So the pillow test is this. If the last thought that you had at night when your head hits the pillow is your investment portfolio, then you have not passed the pillow test. So basically, if you're not sleeping well at night because you're too busy thinking about or stressing about your portfolio, then you do not pass the pillow test. So if you're considering purchasing a stock and you're on the fence about it, you're not sure, you haven't done all your research, just don't do it. You want to be 100%. Obviously, everything is speculation. Nothing is 100% in this world, but you want to be confident in your choice with your investing strategy, so you need to pass that pillow test. So when your head hits that bed at night, you're sleeping well. And right now, that is how my portfolio is. There are some stocks I have considered purchasing that I'm not going to. One, for example, is AT&T. One can make an argument for purchasing it, but I'm not comfortable with it. I don't know enough, so I'm not going to. I'm not claiming to be an expert here, and I'm not an expert. I'm a 25-year-old kid figuring this out, So I want to be fully transparent with you guys, and the holdings that I have are holdings that I'm comfortable with. Now, another thing is who is this portfolio being created for? This really changed the direction of my portfolio, right? Are you going for income? Are you going for growth? Are you going for a little bit of both, right? So there's some great income investors out there who have really high yielding stocks, right? So here's a few. MMP. Right? This is for me a solid company, and it's a solid stock to own with an 8.35% dividend yield, right? Here's another one, MPW. It's a REIT. Look at that dividend yield, 10.4% with a nice dividend safety rating, right? There's some other closed-end funds that are great. UTG, right? Another income fund, UTF. So these are great funds to own. However, it does not fit my strategy and what I'm going for, right? I'm going for dividend growth. And the reason why is because I have 25 plus years to build this portfolio. I don't plan on retiring early right now. I mean, I do plan on retiring early, but not in 10 years or 5 years. And if I was going to retire in 5 years, yeah, I'd go for these because I'm getting that dividend income right away. And these are quality stocks where the principal does increase over time, right? So you're not going to be losing your money or losing your principal. So what strategy are you going for when building your portfolio, and who is it going to be created for? You can see stocks that I own. Home Depot, a little bit different story. 2.3% dividend yield, but look at the dividend growth in the last 5 years, 18%. Here's another one that I have. AVGO, 3.3% dividend yield, which is nice. I like. Look at the last 5 years dividend growth, 29%. Now, this obviously isn't going to be sustainable forever, but this company is growing fast, and I want to get in on it now. So it's growing fast, has a lower payout ratio, and a semi-lower yield, this one, right? Here's another one, Visa, a really low yield, and a low payout ratio, and high dividend growth. So that is my strategy, and that's what I'm going for. I'm going for this because I have a long time to invest. And if you run the numbers, investing in a company like Visa versus one that I just showed you, like an income fund or a closed-end fund, UTG, in 20 years, the total return on Visa is going to be so much higher. So much higher than UTG, right? So that is one thing that a strategy idea that really helped me when I built my portfolio. Now, another thing is that I want to go over is the ideal portfolio size. Now, I read in Dividends Don't Lie that the ideal portfolio size is 25 stocks. Now, there's a lot of arguments that, oh, having 10 stocks is better, right? Having less is more, right? But for me, 25% is the sweet spot. Now, why is that? 25% is good because it allows for wide diversification, and you don't own too many stocks to where you can't track it effectively. You can track it effectively, it's well diversified, and by limiting to 25 stocks, there is a higher probability for outperforming the broader markets, right? If you own too many stocks, like 50, I mean, you might as well just own an index fund, right? That's my personal opinion here. So figuring out the ideal portfolio size, and for me 25 is good. I can have everything equal weighted at 4%. So if one of my holdings were to completely just get destroyed, 4% of my portfolio isn't going to kill me. It's not going to, it's just a little dent in a big size portfolio, right? Another thing is the dividend yield theory that I wanted to go over. Now, what is the dividend yield theory, right? So basically, it's if a stock's current yield is too high above its historical yield, then that stock is likely undervalued. And it's that simple. And vice versa, right? So that is one way to find the value of a stock, and it's called the dividend yield theory. I would look into that a little bit more. I'm not going to go over that too much here, but that is one thing that helped me with my strategy, right? So another thing is learning to tell when a dividend is in danger. A stock's dividend is in danger, right? And usually that's when there's a really high payout ratio because they're not able to pay their dividends, or they're going into debt to pay their dividends, right? When you have a high payout ratio. So you want a low payout ratio, and that's how you can tell when a dividend will likely be increased, is when there's a low payout ratio, right? So I don't want to confuse you guys, but just know high payout ratio, bad. Low payout ratio, good. So that is just key things that kind of helped me on my journey. And then another thing that I preach about a lot on this channel is yield on cost. When I learned what yield on cost was, and that Warren Buffett has a 50% yield on cost on Coca-Cola, that means his cost basis was about $3 when he purchased Coke, and now he's getting $1.70 for each $1.70 in dividends for each stock that he owns, which is absolutely insane. So when I figured out what yield on cost was, that really, how can I explain it? It really motivated me to keep investing in this strategy because, it is slow. I don't see a lot of high rolling dividends come in, and that's what keeps me motivated. But knowing that I'm investing in solid companies that are growing their dividends helps keep me invested. It keeps me investing, and it keeps me motivated and inspired. So you can see my portfolio consists of a lot of these stocks: CNI, Costco, Duke, Home Depot, Johnson & Johnson, Lockheed Martin, Lowe's, MasterCard, Altria. Altria goes against everything I just said, but I love me some Altria, so don't hate on me for that. Microsoft, NEE, Pepsi, Southern Company, Target, T. Rowe, Texas Instruments, UNP, Visa, WP Carey. So guys, as you can see, most of my stocks are low yielders but high dividend growth. And this is how I developed a successful dividend stock strategy. And learning these things over time, it took me a long time to figure all this out, So hopefully this provided some value for you, and you're able to figure it out a little quicker than I did with this video. And guys, keep investing. I make videos every day, so I'll see you tomorrow. Bye.